the recession hasn't happened. And the fear that I have is that we could still have a recession around the corner. We had an inverted yield curve for a couple of years. It's uninverted. And when you look at the history of recessions, I don't have the numbers in front of me, but many of the recessions happened after the yield curve uninverted. And my fear is that a lot of people think that the stock market is a safe haven. And a lot of people might think that we're not going into recession, and that could be a big mistake because we're not recession proof and it still could be around the corner.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network. Now, more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz, as we get into the last week of October of 2024. What is going on? We all know elections about to take place, for better or for worse. There's always one sure loser in every election since I've been alive, and that is the American public. So I don't see anything that's going to make this any different than all the others. The debt keeps piling up, the economic challenges. Somehow, Anthony Saccaro's with us. Anthony, I see bad things happening to the country. We don't need to get into them, but yet, these big companies, I think they said 10 large companies are born every decade in America, something like that. Did you see that statistic? So we have Tesla, NVIDIA, we have all these large companies that really literally came out of nowhere. So in spite of things being bad, these companies keep cropping up here. What's your take on it?
Yeah, I did see that, and I've read other studies. And by the way, Kerry, thank you for having me back.
Sure.
Happy Halloween to all of you listening. Halloween's right around the corner. The thing that is interesting about this is Apple is a great example of a company that a lot of times people will hang their hat on. We recently had a client that we took on that invested $10,000 of Apple. I want to say it was like 92 or something like that. And he wound up cashing out at $1.8 million when we took him on. This was a couple of years ago, and that's the way that the math worked. And so what I find happening is I find that a lot of people will hang their hat on a particular company, and instead of riding a diversified portfolio of stock to success, they'll hang it on one company. Now, we have to remember that for every Apple that's out there, there were probably 10,000 wannabe Apples that, failed at the same time that Apple succeeded. And what scares me, and I see this as starting to be a trend, is that a lot of people will pick a company, Apple back in the day, NVIDIA now for their chips and the AI craze that's going on, and almost looking for that one company to really ride them all the way to success. And I think that's a very dangerous approach. If you take a look at, companies in general, they all cycle. They're companies that are on the perch today may not have existed 25 and 30 years ago. Think Google and Amazon, right? And companies that are out of business today were the top companies 75 years ago. Think Woolworths, right? Think Sears, and so on. And if you look at the Dow 30, for example, the 30 biggest companies in the world, the reality is if you go back 80 years and you take a look at the companies that were in the Dow 30 biggest companies 80 years ago, and you compare that to today, most of your listeners probably would be surprised to find out that there are exactly 0 companies in there today that were in there 80 years ago. The last holdout was GE, and GE got booted from the Dow, 3 or 4 years ago?
Yeah,
because of the problems they have. And so, sometimes people will say, well, I'll just invest in those companies and I'll just ride that for the rest of my life. No, if you would have done that 80 years ago, you would be out of luck today. And so none of the 30 top companies 80 years ago are in the top 30 today, but it gets worse. And that is that other than GE, the other 29 companies that were the top companies in the world 80 years ago are all out of business. they weren't able to change and adapt. And we are in such a changing and adapting that top companies today are not going to be top companies in the future. And you need to have a diversified portfolio of a lot of good companies, not one. But I do see a trend of people taking a lot of money and putting it into one stock that they hope is going to win. Tesla, Netflix, NVIDIA, and that's a dangerous trend to do. Yes, you should have some in your portfolio, but don't base your entire future on one stock. And I see a lot of people wanting to do that.
Interesting analysis there. And yeah, like the companies have their 20, 30 year run at things, right? And then maybe some of them go 40, 50, like GM, Ford, and then they fall, right?
Exactly right. The faster chimes change, the more companies are going to fall. Think Blockbuster, right? That Netflix came along and realized that why do we have to go to a store? Why do we have to rent a tape? Why do we only have 7 days? And when you look at Blockbuster and you've studied the history of Blockbuster, what you realize is that a part of their business plan and a part of their revenue, a part of what made them good and profitable was the fact that they charged late fees on the people that didn't bring back these videos in time. Now, call me crazy, but setting up a business and running a business to where your profitability is going to depend on penalizing the customers for not doing that, that's a recipe for failure. And then when Netflix came out and said, no, we're going to produce these things and we're going to deliver it to you right in your home and you don't have to go to Blockbuster, Blockbuster could have been Netflix if they had pivoted, but they didn't. Same thing with Kodak. Kodak could have been in the digital space when it comes to film, but they didn't. So at the faster things change, the more companies are going to drop off. And with AI and with the things that are going on today, you're 100% right. You have to really be careful. Companies that are on top today may not be anywhere to be seen in a decade.
Interesting. You mentioned Blockbuster because that was founded by Wayne Huizenga. And he was the only person to ever found three S&P 500 companies: Waste Management, AutoNation. So Blockbuster's gone. He was long out of it. He saw the handwriting on the wall. And then we had AutoNation. That's still going pretty good. And Waste Management, the last I heard, people were still producing garbage at record rates, right?
At record rates, yes.
And still recycling. It's kind of crazy when you think about it. So let's talk about Federal Reserve. Regardless who wins, we still got to deal with the Fed here, right?
Yeah, 100%. Federal Reserve has two mandates: low inflation and low unemployment. They've had low unemployment for a few years now. Unemployment ticked up to about 4.3% until a few months ago was under 4%. So it's right where it needs to be. As far as inflation is concerned, their target is 2%. They're in that level now with the mid twos, depending on whether you look at the CPI, the core CPI, or the PCE. It's all in the mid twos, and they have to make changes before they get to their target level because they don't want to be behind the eight ball like they were when inflation started going through the roof. So they lowered the 50 basis points as their last cut. It's widely predicted that in the next Fed meeting or the Fed meeting after that, they're going to go another 25 or 50 bips. And then in 2025, maybe another 1% or so, something like that. So it's been predicted that they'll do 200 bips over the course of the next years.
You missed one thing, though. The Fed actually has three functions: keep prices stable, keep employment levels stable, and keep the stock market from going down.
Yeah. That's what they say, right? That's what the president says. That's their third function, but it's an unwritten function that really is not a part of anything that they're supposed to be considering. And they'll tell you that they're not. But when it comes to the election cycles, there is this debate about, they don't want the market to fall because if the market falls, then all of a sudden recency bias comes into play. Recency bias is the simple fact that we tend to act on what happened recently. And if the market fell recently right before bad timing, it could affect the election. So they do have that in mind. They're not supposed to have that in mind. You can't keep it out. It's all intertwined. And lowering by 50 bips is certainly going to help the stock market. That's why the market's hit some record highs other than the, few bumpy days that we've had. But you're right. It's really not a mandate of theirs, but it's kind of implied into what they do. But it has been predicted and it is forecast that they're going to lower by 200 bips over the course of the next couple of years. That could be good for the stock market. Is it going to keep us out of a recession? That's a big question that consumers are asking. The reality is, we don't know. They've been talking about soft landing. They've been talking about hard landing. They've been talking about no landing. It's just the longest time period that I remember where we've been talking about a recession, and the recession hasn't happened. And the fear that I have is that we could still have a recession around the corner. We had an inverted yield curve for a couple of years. It's uninverted. And when you look at the history of recessions, I don't have the numbers in front of me, but many of the recessions happened after the yield curve uninverted. And my fear is that a lot of people think that the stock market is a safe haven. And a lot of people might think that we're not going into recession. And that could be a big mistake because we're not recession proof and it still could be around the corner. You need to invest. So whether we have a recession or not, you're going to be just fine. And I find that a lot of people are investing in a way to where if the stock market does bad, it goes against them. It's going to wreck their retirement. It's going to wreck their future. Don't do that. Invest in a way that's right for you, for your phase of life, so you have the ability to win no matter what. If you're invested right, that's what should happen. It shouldn't matter who wins the president, and it shouldn't matter whether we have a recession as to whether you'd be able to accomplish your goals or not.
It shouldn't, but if you're later in life and you take a big hit, that's going to make a big difference in your life, isn't it?
100%, which is why you shouldn't be in a position to take a big hit. And this is something that I talk about on my radio show, my podcast. I talk about in my book. You have to be invested properly for the phase of life that you're in. If you're invested in such a way to where you can take a big hit, and if your retirement is going to be affected if you take a big hit, then you are invested wrong. You need to be invested in such a way to where you're going to be able to retire when you want, or you're going to be able to stay retired if you're already retired. I don't want you invested in such a way to where if the market does well, you can travel. If the market does well, you don't have to get a part-time job. If the market does well, you can do the things you want. I want you to be able to travel and not have to get a second job and not have to keep working and retire on schedule, regardless of what the market does, even if that means you have to get your portfolio more conservative. So you have to be invested properly for your phase of life, and you should not be in a position to where your retirement's going to get wrecked if the market doesn't do what it's supposed to do.
So, but over time, and now we've got hundreds. Well, in the U.S., we've got it goes back to the 1880s, the advent of the Dow Jones index. But in Europe, it goes even further. But since the advent of the Dow Jones, a dollar invested would reap huge returns. We still have never found a machine that creates wealth like the financial markets, especially the stock market, have we?
Well, no. When you look at the history of investments and what investment has done the best over time, the stock market is certainly in that category. And you look at the past 100 years, the Dow Jones going back to the late 1800s. I know it's going to average somewhere between 8 and 10% a year, but the fact is that there are long periods of time where the market, including the Dow Jones, is flat. And then there's long periods of time where the market does 15% plus like we've had for the last dozen years. And it depends on what generation or what decade is going to be next. But the history of the market tells us that there's bad decades followed by good decades followed by bad decades. Even if you go back the last 25 years, we're coming up on 2025. Let's go back to the turn of the century and kind of see what's happened there. From 2000 to 2013, we had the crash of 01 and a recovery. We had the crash of 08 and a recovery. For 13 years, if you draw it out, it's a big W. There's no growth in the market for 13 years. And if you wanted to retire in 2000 and you were planning on following the rule of 4% and selling, spending down your portfolio for the next 13 years, you would be really close to running out of money because there was no growth in the market over that 13-year time period. Compare that to the last 13 years. The market's up 15, 16% a year on average. So when you average the two together, the reality is that you wind up with 7, 8% a year. You throw in some dividends, you're going to be 9, 10% a year. But averages can be very misleading. In the way of the stock market, the first decade and a half was horrible, no growth. The last decade and a half was great, but it's misleading, even though we can say it averages 8 or 9% a year. I can tell you, Kerry, truthfully, a good example of how misleading averages can be in real life. In my example, my wife and I we average about 10 miles a week. It's true. But the reality is that's not the whole story. The way I get there is that She actually loves to run, and she runs about 20 miles a week, and I don't run. So the reality, though, is don't we average 10 miles?
You have a good average, though.
We have a great average, but the reality is when you know the rest of the story, it paints a different picture. And it's the same thing with the market. If the market does in the next 15 years what it's done in the last 15 years, I don't care what you do. If you're spending down your portfolio, if you're following the rule of 4%, you're going to be fine. But if the market does in the next 10 or 15 years what it did in the first 13 years of the century and you're spending down your portfolio, you could be out of money and you could be in trouble. And that's what I don't want to happen to you. So yes, if you're trying to accumulate, you have 20 or 30 years ahead of you, be in the market, be in mutual funds, great strategy. Over time, 20, 30 years, you'll average 8, 9%. There's never been a 30-year time period in the market that it hasn't done that. But if you're in retirement, you can't afford that the next decade or decade and a half, the market's going to be choppy and no growth and be selling assets at the same time. You have to be focused on living off the interest and dividends of your portfolio so that you can protect your principal. And if that means less returns, so be it. It's accomplishing your goal.
Well, it reminds me, I think John Maynard Keynes said, in the long run, we're all dead, right?
That's exactly right. But some people are dead with more stress than others.
Yeah.
Running out of money, if you're invested wrong and you're selling shares, you're following the rule of 4% and the market tanks and now you got to sell more shares. And you know you're in a race against time because you're cannibalizing your principal. That thought, knowing that you have to die before you run out of money, that thought can actually kill you.
Or make you wish you were dead anyway.
Right.
Well, Anthony, just tell us, where do we find you? How do you connect with people? How can we connect with you?
Yeah, I think the safest way to go is you can go to anthonysaccaro.com. My businesses are there on the website, providencefinancialinc.com, or if you just search Providence Financial Woodland Hills, which is California, which is where we are, we come up all over the place. And if you have any questions, your listeners have any questions about anything we say, more than happy to answer those questions as well too. So.
All right. Well, the link to your site is in the show notes of this interview on financialsurvivalnetwork.com. So just go there and click it. While you're there, please sign up for your free newsletter. Got a question for Anthony, myself, KL@kerrylutz.com is the place to send the email. Always appreciate you coming on, Anthony. We'll talk to you again real soon.
Thank you for having me, Kerry. Appreciate being here.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.